Bank of Uganda. As per the mandate, today we are set to issue the monetary policy statement, and the Deputy Governor and his team are ready to execute that mandate. For introduction, the Deputy Governor is Mr. Michael Atingego, and he's accompanied by his team of 3 executive directors. Executive Director Research, Dr. Adam Mugume; Executive Director Supervision, Dr. Twinemans Tumubwaine; and Executive Director Operations, Dr. Charles Abuka. I am Dr. Natamba Bazinzi from Communications Department. So you are welcome. Deputy Governor, sir, it's your turn now to issue the statement.
Thank you very much, Director Communication. And a very good afternoon to all the viewers and the listeners. Welcome to the reading of the Monetary Policy Statement for the month of June 2023. At its meeting held on 13th of June 2023, the Monetary Policy Committee maintained the central bank rate at 10%. Uganda's economy has demonstrated notable strength and resilience amidst unpredictable global economic dynamics. Inflationary pressures are easing, and economic recovery is underway despite ongoing uncertainty and evolving risks in the global economy. The Uganda Bureau of Statistics data for October 2022 to May 2023 shows that inflation has declined on account of steadfast and prudent monetary and fiscal policies, stability in the exchange rate, and due to the falling food, energy, fuel, and utility prices. Annual headline and core inflation decreased to 6.2% and 5.6% in May 2023 from 8% and 6.8% in April 2023, respectively. Annual inflation for electricity, fuel, and utilities receded to 0.9% in May from 2.1% in April 2023. Similarly, food crop inflation eased to 15.7% in May 2023 from 25.3% over the same period. Inflation for goods, including imported items, declined to 7.4% in May from 8.8% in April 2023. Also, services inflation has remained low, averaging 4.2% since January 2023. The contractionary monetary policy stance pursued since June 2022 to date, coupled with the decreasing global inflation, is expected to reduce inflation further in the upcoming months. As a result, headline and core inflation are forecast to reach 5% in the third quarter of 2023 and remain stable around the target over the medium term, which is 2 to 3 years ahead. Despite the improvement in the near-term inflation outlook relative to the assessment at the MPC meeting of April 2023, the current inflation projections remain sensitive to elevated risks. The downside risks to the inflation outlook include potentially lower global cost and commodity price pressures, minimization of global supply constraints, favorable weather conditions, and sustained unused economic capacity. The upside risks to the inflation outlook include potentially higher demand pressures from a more substantial economic recovery, elevated import inflation, the tighter global financial conditions, which could weaken the shilling exchange rate, that in turn would exert pressure on consumer prices. Also, domestic food prices remain highly susceptible to the unpredictable weather patterns that would turn drier in the coming months. Currently, the MPC assesses that the near to medium term inflation outlook are trending downward, albeit subject to elevated uncertainty. Now, turning to economic recovery, the Uganda Bureau of Statistics estimates economic growth at 5.3% for the fiscal year 2020 stroke 2023, up from 4.6% in 2021 stroke 2022. The agricultural sector recovery, resilience of the services sector, and the considerable household consumption propped up economic activity, countering a less supportive external environment. Furthermore, high-frequency indicators signaled accelerated economic activity in the recent months. Also, consumer and business sentiments have exhibited positive momentum. The MPC projects economic growth in the range of 6 to 6.5% for the fiscal year 2023/2024. Economic growth is anticipated to return to its sustainable long-term trend in 2024/2025, bolstered by investments in oil-related infrastructure, the energy sector, transportation, and a recovery in the manufacturing and construction sectors. In addition, potentially more robust external demand for Uganda's exports and supportive government expenditure are expected to elevate economic growth above the 7% in the medium to long term. Nevertheless, economic growth remains highly uncertain, with the balance of risks leaning towards the downside. The potential downside risks include protracted weak global growth and lower commodity prices, constraining Uganda's export earnings and widening the current account deficit. Secondly, a resurgence of the supply chain distortions due to geopolitical tensions and fragmentation. Thirdly, a potentially lower external concessional financing, which could restrict government expenditure. Fourthly, higher public debt burden could weaken the local currency, limit government's borrowing capacity, and slow foreign investor inflows. Fifthly, a combination of a moderate private sector credit growth, rising domestic interest rates, fiscal consolidation, and the shilling depreciation could weigh down growth. And finally, higher frequency and intensity of climate shocks, including droughts and floods, may undermine agricultural activity and worsen food insecurity. On the upside, the slowdown in global economic growth in the near term may be less severe than anticipated, and a faster regional trade integration could bolster potential growth in the medium term. Also, domestic economic growth could surpass expectations, aided by supportive government expenditure and private sector investments in the extractive industry. Heeding caution, mainly because of the elevated uncertainty in the global financial markets amidst slowed global growth, coupled with the dominant impact of the vagaries of weather on agricultural production, the MPC views the downside risks dominating economic outlook. The dominance of the downside risks to economic outlook, coupled with the growth remaining below its long-run average poses challenges to the sustainable restoration of price stability without urgent measures to boost productivity and enhance the economy's supply side. Therefore, it is imperative to consolidate the gains made by tight monetary policy, helped by fiscal consolidation, in restraining the recent inflationary pressures while undertaking commensurate interventions to upscale the production and the productivity of the economy. In other words, the fight against inflation can sustainably be won in the long run by boosting the economy's supply side to meet the growing needs of a dynamic economy that is undergoing structural transformation. This will require boosting economic production and productivity to foster sustainable macroeconomic stability for economic growth and development. After careful deliberation, the MPC recognized that significant risks persist in the economy and that the current monetary policy stance remains appropriate to consolidate the gains made and restore price stability while supporting economic growth. As a result, the MPC has decided to maintain the CBR at 10%. The CBR's operational bands will remain at plus and minus 2 percentage points, while the margin on the CBR for the rediscount and the bank rate will be maintained at 3 and 4 percentage points respectively. Consequently, the rediscounts and the bank rates will remain at 13% and 14% respectively. Also to note is that despite the recent challenges experienced in the United States and European banking sectors, the domestic financial system remains resilient and on track to meet the revised regulatory requirements, including those related to higher minimum paid-up capital. The future adjustments to the monetary policy stance will be contingent upon new information regarding inflation and growth. That marks the end of the reading of the monetary policy statement for the month of June 2023. Thank you for your kind attention.
Thank you so much, Deputy Governor, for issuing the monetary policy statement. And our partners in the media and the general public, it's now your chance to ask questions related to the monetary policy statement that has just been issued. Yes. You say you are media house and then you ask.
Thank you very much. My name is Wadulo Makanol from Uganda Broadcasting Corporation. And my question goes to say that seeing that the CBR has been maintained at 10%, but we still monitor, but we still see dynamic movements in the back, say in, of course, inflation. Inflation is also, and I understand that this is a tool supposed to kind of regulate or monitor or control inflation in per se. What are some of the influences that are happening in the back that are still influencing central bank to maintain it at 10%? Because inflation, we realize, is coming down, but we're maintaining it at 10%. So I'll just need some clarification on that. Yeah.
Thank you, Mark. You're Mark Watulo. I think I've been seeing you on TV. Yeah, thank you, Mark, for your question. Indeed, you're saying that while our projections for inflation are on the downward side, we are still keeping the CBR at 10%, and yet the CBR is supposed to be signaling where we think inflation is going to be. I think I did mention that we still have some uncertainties that that we're faced with, and also the current inflation projections remain sensitive to elevated risks. So in other words, we need to ensure that this level of elevated risks are kind of like contained before we begin lowering the CBR. So it is the uncertainties in the context of the elevated risks where we are being very cautious that we don't want to begin lowering the CBR at this time, because if these risks materialize, then it means, right, that we will again be back onto the inflationary trend. So we first want to ensure that we get hold of this, we contain these risks, and we're certain that the risks are well contained, including, of course, the supply side, which we think needs also to get firmed up so that the pressures that are coming out of the supply side shocks are also reduced. And then we can comfortably begin thinking of how to lower the CBR. But I'm accompanied by the Executive Director of Research, and I'm sure he has something to add. Adam.
No, DG, you have explained it quite well. It is true that, for example, looking at the global development, there's a lot of uncertainty globally. We don't know to what extent the global central banks, for example, will continue raising their rates because they still have inflationary pressures. We don't know to what extent the war in Ukraine will drag on and its impact on commodity prices. We don't know, what we are seeing as global fragmentation, how this will evolve over time. So I think in the horizon you have a lot of uncertainties, and therefore holding a ground to first observe and get more information is really appropriate in terms of monetary policy. Thank you, DG.
Thank you so much, DG. We also have online Samuel Setumba from NTV. Samuel, please, you ask.
A couple of questions. Thank you for the statement. Help me understand, maybe DG. Inflation is coming down, but cost of living persists up. I thought that if inflation is coming down, we are seeing some statistics, even some negatives. Cost of living would come down, but it is not necessarily coming down. Help me reconcile those two things. Then the other question is, I had the DG mention fiscal consolidation as one of the things that should help rationalize things. And at the beginning of this financial year, and even I think the last one, there was an alignment of monetary and fiscal policy. And recently there was the ramp up of pronouncements along fiscal consolidation things. But do you feel that fiscal consolidation is on track now, that we saw the budget raised from 48 rather to now 52, I think, trillion? Are we on track at all concerning fiscal consolidation? And finally, our reserves. I notice that we are below 4 months, stand to be corrected, but I think we are below 4 months and no signs of rising up. Being at that level is, in my view, risky. We could get a shock. What's your feelings towards our reserves? reserve position, and is anything in that position?
Okay, Samuel, I seem to have lost you on the latter part of your third question. But the little I got you asking, you know that the reserves are coming down. So I don't know what was your question, because I need to be specific in my answer.
The question is, what are your feelings towards our reserve position? Are you okay? Are you comfortable? And is anything being done to prop up these reserves? I know one time we even went up to 5 months. Now we are at below 4. What's your take on that?
Okay, thank you very much, Samuel. I will just give maybe the bigger picture of the responses to your questions, and then the details. I will ask Adam to fill in the details. Your first question was, inflation is coming down, but not the cost of living. Yes, you are partly right, because first of all, what is inflation? Inflation is the rate at which prices are changing, right? So let's take, for example, in October last year, inflation was 10.7% headline. As we talk right now, the inflation number for the month of May is 6.2%. That's for the headline. So what does that mean? It says that the rate at which prices were rising in October was 10.2%. Now, the rate at which prices are rising in May 2023 is 6.2%. It does not mean to say that prices are coming down per se, but it is the rate at which the prices are increasing that is reducing. So that increase in the prices are still rising, but the rate is coming down. So it is still affecting the cost of living. And that's why we're saying that we need to bring down this inflation to the medium-term objective of 5%, which is supportive of economic growth of about 6 to 7%. And it's when we achieve that 6 to 7% with inflation of 5%, that's where we think that the cost of living will possibly come to what is reasonable. But right now, the prices are still rising, but economic growth is still below its potential. And so that might explain why the cost of living is still a challenge. Now, you talked about the government expenditure. I think we need to measure the government expenditure relative to some common denominator. An increase of 48 to 52 trillion shillings from this year to the next financial year needs to be looked at maybe in terms of, one, how are the revenues performing over the same period of time? How is GDP performing over the same period of time? So when you talk about fiscal consolidation, you need to look at what is the deficit going forward. Is the deficit going forward reducing? And I think that's what we are looking at, that the revenues the expenditures minus the revenues, that gap is coming down. So that's what I would consider as fiscal consolidation, particularly when measured in terms of GDP. So the deficit relative to GDP is coming down going forward. That's the way I understand fiscal consolidation. And then you are right in terms of the reserves, in terms of the month of import coverage. This has come down from about 4.5% that we saw recently to now about 3.5, 3.6, actually about 3.6. Now, Samuel, you are aware, I think we've been explaining over and over again why the reserves have come down. First, you need to understand what was the source of our building reserves in the recent past. Because of the ultra low interest rates in some of the advanced economies, the risk appetite for a number of investors to participate in the securities markets of emerging and frontier economies was high, given the fact that the interest rates on government securities in these economies was higher when compared to the interest rates in the advanced economies. But with the onset of the inflation starting early last year, the central banks of the advanced economies started to raise their policy rates. And as a result, the interest rate differential between the emerging and frontier economies and also those of the advanced economies began to reduce. And also there was the aspect of safety, because the investors were looking for certainty and safety for their investments in a global environment that was getting fluid, that was getting uncertain. So there was a flight back to safety, notwithstanding the reduced risk appetite for investments in emerging and frontier economies. So our capacity to buy reserves or to buy foreign exchange reserves, which had been driven by the high risk appetite earlier on, was now dwindling. So we could not build reserves at a rate at which we were building in the past. So that means that we were not replenishing our reserves, notwithstanding the fact that the outflow of reserves on account of debt service was beginning to pick up, because the estimated debt service, for example, in 22-23 is about $950 million. And that is a number that we have not seen in the recent past. So that had an impact of lowering our reserves in a situation where we had a limited capacity of building up reserves. So that explains why the reserves have come down. Now, is that a healthy situation? Certainly not. It's not healthy. But so we are doing everything possible to ensure that we build up the reserves. And I'm glad to inform you that, notwithstanding the fact that our capacity to buy reserves had been constrained, we have resumed the purchase of foreign exchange in the market, starting sometime in November last year. Up to now, we've been buying some foreign currency, and we have bought north of $200 million from the market as an attempt to rebuild the reserves. Also, we expect to get some disbursements or balance of payments from some of our development partners. And given the fact that government expenditure is in shillings, these budget support funds that are coming in dollars will be sold to Bank of Uganda to release the shillings for government, and that's going to contribute to the reserve buildup. So my feeling, therefore, is that we have begun the path of building reserves and will continue to sustain that path, particularly when the foreign exchange market remains stable like it has been. So, and it will be helped by the fact that government is undertaking fiscal consolidation, which should also help in reducing the cost of debt service going forward. So that's what I have to maybe answer to you, Samuel, on the three questions that you raised. But again, like I promised, Adam will add something to what I've mentioned. Adam, please.
Thank you, DG. Some on the question of fiscal consolidation. I think fiscal consolidation is on two fronts. One is to what extent is the government expenditure rising, and the second is to what extent is tax revenue mainly rising. And so it is the combination of the two that will give you an idea of whether there is fiscal consolidation. And the sum is the fiscal deficit. For example, in 21-22, I think fiscal deficit as a ratio of GDP was more above 7. I think it was around 7.3 or so there % of GDP. In this year that is ending this month, fiscal year, fiscal deficit is estimated around 5.1 of GDP. Next financial year, it is estimated around 3.5% of GDP. So overall, we can see that is the track of the consolidation we are talking about. To the extent that the fiscal deficit is declining, and therefore having a combination of both tax revenue and also increase and also government expenditure that is not rising as fast is really what gives an idea of the fiscal consolidation. Now, when you talk about therefore 52 a budget of 52 trillion, I think you, as DG said, I think you have to reflect on what is going on in terms of both revenue and expenditure. Some also you said the cost of living. I think the cost of living, as DG said, if you look at the basket, actually we have to be sincere that there are some items that we know for sure that really have come down. For example, fuel prices. Remember, I think it was last year when fuel, the farm prices rose up to around 7,000 per liter of petrol. Since I think we can see now that fuel prices have come down to around 500 shillings, 5,000 shillings per liter, which is really a decline. So overall, we can see in the basket of the household consumption basket, you can see that there are some key items whose prices have come down and therefore partly contributing the cost of living. However, on aggregate, we know that the basket, again, the prices have gone up on average, as we said, by 6% in the as of May. But overall, I think there are some, I wanted to amplify that there are some items in the basket that are clearly pointing to the decline rather than increasing. And some of these obviously are related to what is going on, as I said already, in terms of global prices. And I think on reserves, I think we always, obviously, better reserves is, much reserves is always welcome. But also, in some cases, you can't just buy dollars, as if they are not costly. So I think it is a question of whereas reserves are really, the more reserves, the better. But again, you have to reflect on the economy you are dealing with. So idea to go in and start buying reserves for the sake of accumulation and therefore causing another distortion would not be ideal. So it is not true that therefore it is not necessarily the case that the dollars are not in the market. But what the question would be, what would be the cost of getting the dollars from the market to accumulate reserves and therefore causing another distortion in the economy? And I think that's what, as a central bank, we always try to avoid. You accumulate reserves when conditions are necessary. But in any case, when you have, where we are at 3.6, 3.8 months of import cover, are much higher than what is internationally recognized in terms of the threshold. So I just wanted to downplay the idea that reserves have come down to say that actually, yeah, where we are, we still have sufficient reserves. Thank you, DG.
Thank you so much, DG. We have a few questions from the chat, and these are from Ali Twaha of New Vision. And he asks that during the last Treasury bill auction, yields edged slightly higher for the first time in months. How should we interpret that move? He has a next one related to gold, and he says that gold has made a comeback with total exports nearly doubling on a monthly basis. Besides the removal of the levy, kindly help me understand these trends. And then lastly, that since the outbreak of the pandemic, I have not seen the annual informal cross-border trade survey report. He says that he understands that Adam participated in making it. So he asks that that Adam provides an update. So DG, those are the questions we have from the chat at the moment.
I think most of those questions are really directed to Adam, the annual informal cross-border trade, and also the exports. And then maybe we'll look at the yields in the most recent auction. Adam.
Twaha, thank you. I think ICBT is, I will refer it up to, but we already have ICBT data ICBT data every month. And I'm not sure what you mean by report not coming through, but I will check. I know that we used to have some report that would publish, but in terms of the numbers, they are already available. If you see our balance of payment, you will see a line somewhere below that gives the details of informed cross-border trade. And this is on average, we are talking about around 50 million, 500 million, I think, worth of goods in terms of ICBT per annum. So those really, the data is available, and I'm going to check whether there is any other report that we usually provide to the media that we haven't updated. I apologize if we haven't updated the report. On gold exports, you have put it right that after the suspension, when the lifting, it was, I think, temporary suspension of the taxes, we saw gold exporters starting to export, and you're absolutely right. We have seen since, I think, since March, we saw an increase in gold exports. As of to date, this financial year, we have of more than 500 million worth of exports of gold. Apart from that, as we always say, what we export is largely imported. So, and therefore it is on both ways. We import the gold, do the processing, a bit of value addition, and we export. So I'm not sure, apart from that, I know that we have also our domestic miners that have started mining gold, but we are yet to get clear information on how much they are extracting, locally, and how this processed, and whether it is substantial volumes in terms of what we see as gold export. But for now, what we see in the numbers from URA is that the processors import the gold from 2 or 3 countries, process it, and re-export.
Okay, you also asked about the yields in the last auction. I think the only explanation is that what was taken up in the last auction was much higher than what had been offered. So that explains why the rates went up. Maybe Dr. Buka, you want to add something?
DG, we have another question from Yasin Amin, that may you please let us know how much for local debt by offshore investors. He also asks again that this is considered as hot money, and if rates of shores keep going up, that there is a likelihood that people will make more money out of better yields outside than I think imports on revenue, than impacting on reserves,
Can you repeat that?
He says that may you let us know how much of local debt is held by offshore investors, and then he explains that this is considered as hot money, and if rates offshore keep going up, that there is a likelihood that people will take more money out for better yields outside, further impacting on reserves.
Yeah, thank you. I don't have the exact numbers, but if my memory serves me correct, and Adam will correct me here, I think we had reached somewhere around 13-14% before declining to about 8% more recently. But Adam, you can maybe give the exact numbers on that.
No, I know currently the offshore are holding around 2 trillion Uganda shillings, which is equivalent to what we said, around 8% of the total government securities. And they used to hold around three, at one time actually it had gone up to 3.5 trillion, which was equivalent to around 15%, then gradually coming down.
Governor, we have another question from Mark Arnold of UBC TV, that the shilling continues to struggle against the dollar, averaging at 3,700 for the past 2 years, with signals of touching 4,000 in the near future. How is the MPC helping to keep the shilling competitive?
I need to be what is struggling? Because he says of the last 2-3 years. So if the thing is steady at 3.7, is that struggling? I thought that's the stability we're looking for. Because we as MPs were interested in stability. And I think we have delivered on the currency. So the currency is stable, so MPC has achieved what it wanted.
Thank you. Deputy Governor, those were the questions, and allow us to thank the public and the media for being part of this. And we promise to share the report immediately after here, and also to promise the public that we will be taking this message on our social media platform, radio and TV. For now, we thank you and wish you the best.